Good morning and welcome to the Energy Perspectives Group webinar hosted by Goodrich Petroleum. This event will be recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Hey, good morning, everybody. We've got a great speaker today, but first of all, I want to, update you on my feeling about the U.S. gas market because Goodrich, about 99% of their production is natural gas. So this is a true gasser. But before I introduce him, I want to. Yesterday, EIA reported that natural gas in U.S. storage was 1,793 BCF on March the 5th. That's 141 BCF below the 5-year average and already lower than the 5-year average end of winter storage level. And we probably have another 4 to 6 weeks of draws before we get to the end of this winter heating season. My forecast is that another 225 BCF will be drawn from storage over the next 6 weeks. And then on April 30th, because the draws will go small draws well into April this year, U.S. storage will probably be 4 to 450 BCF below the 5-year average. So it's going to be very tough to rebuild storage before the next year because lower U.S. gas production, strong industrial and power generation demand, and higher exports this year will make it very difficult, if not impossible, to refill storage before the next winter heating season. The last time this happened was in mid-November of 2018 when we were entering the winter heating season with gas and storage below the 5-year average, and the price of Henry Hub gas spiked to $4.60 per MMBTU. You never know what'll happen, but if utility companies are afraid they're not going to have enough gas to make it through the winter, they get into a bidding war with each other in the real world, in the physical world, and that's what drives up the price. So the Wall Street gang is focused on oil prices today, but in a few months, the tightness of the U.S. natural gas market should draw a lot of attention. So anyway, our speaker today is Robert Turnham. He is the president and chief operating officer of Goodrich Petroleum. He's a graduate of LSU over in Louisiana, and he began his career in the oil and gas business in 1981. That's just a few years before I went to work for Hess. And from 1981 to 1984 as a financial analyst for Pennzoil. In 1984, he formed Turnham Interest to pursue oil and gas investment opportunities. And from 1993 to 95, he was a partner and served as president of Liberty Production Company, an oil and natural gas exploration and production company. And in 1995, he joined Goodrich Petroleum as the chief operating officer, and he was promoted to president in 2003. So Robert, I will turn it over to you, and I'll go on mute, and then I'll be back for the Q&A session.
Yeah, great, Dan, and great to be with you again. And thank you to everyone for your participation in this webinar. Before I start the presentation, I think, just following up on what Dan just said, JP Morgan came out with a piece this morning that was spot on what Dan just told you about gas supply, storage, et cetera. Their projection is we exit or we enter the winter season this year at about 2.8 TCF in storage. That's down 700 BCF from last year, and it's down about 400 BCF from the 5-year average. You combine that with the pent-up demand that is current with COVID, the fact that supply is about 90 BCF, a little over 90 BCF a day. That's down from 97.5 BCF a day at the peak last year. You combine that also with the fact that no one wants, in particular if you're a public company, no investor wants to see you outspend your cash flow. They want to see a return on capital. I think that keeps a lid on the rig count, whether it's gassy basins or even associated gas out of the Permian. You're going to be put in the penalty box if you ramp up activity, and I think that's going to keep operators disciplined such that you won't see the response on the supply side, and demand is going to pick back up dramatically. In fact, today, LNG export returned to about 10.5 BCF a day. And Mexico exports at 6.5 BCF a day. So we're really sending and exporting much more than we ever have in the past. And then once we get the demand back domestically, I think you're going to see a really interesting dynamic. So we're very excited about 2021 because, as Dan said, we're 99% natural gas. We do have some forward-looking statements in the deck, and I just caution you on that. But we're comfortable with what we say. We do subscribe to and believe in ESG. Not big enough to do a sustainability report, but we hit the high points here. Frankly, we don't flare hardly any of our gas. The only gas that we ever flare is an emergency situation for a very brief period. So you can see of our production in 2020, we were 0.06% of that production flared, so negligible. Our emissions, pretty low also, and we stand to keep that as low as possible. We're monitoring our equipment, keeping methane emissions down, and doing our best on use of water as well. We do try to recycle if we have a favorable contract for that, but all of our water is fresh water from natural sources, whether it's rivers, lakes, or water wells. We're an independent board, majority of that, 75%, and good minority and gender representation in the employee group. If you look at our assets, we literally are in the core of the Haynesville Shale, which, as I'll show you shortly, is the premier economic gas basin in the nation, and the returns in that basin, when you drill and complete the wells properly, are as good as any company in the gassy basins, as well as the Permian. We're just to whet your appetite at $2.50 gas, because service costs have dropped dramatically. We're generating 100% IRRs or greater in many of our lateral lengths. If you look at our current capital budget this year, we have 12.5-year inventory at that pace. We continue to add to our position. We've added 4,000 net acres in 2020, 2,000 of which were in the fourth quarter. We like, instead of writing checks for inventory, we tend to approach holders of existing acreage. They may be producing from a shallow objective. They may not have the capital to develop the Haynesville, and we've been drilling our way into their acreage. You give them a overriding royalty interest, let them participate in the revenue from those wells that you've agreed to drill, and they're going to get more money that way versus selling undeveloped acres. And we've been very successful at that. I think you'll see us continue to add to our acreage position in the core of the play. When you look at our acreage and you grid that out on the proper spacing, we have over 1.8. It's a little over 1.85 TCF of resource potential under our acreage position. So a tremendous amount of gas in place at current recovery factors. We averaged about 135 million a day equivalent in the fourth quarter. We're projecting to average 165 million a day at the midpoint of guidance in 2021. So although our focus is free cash flow generation, and we've guided to anywhere from 15 to 30 million of free cash flow for the year, we're in a unique situation where we can actually grow 20 to 25% and generate 15 to 30 million of free cash flow. And if you look at that free cash flow yield projection for the next 12 months, granted the back half of 21 is going to be more free cash flow generation than the first half because of our front end loading of our CapEx budget. But if you look at those yields, you're looking at about 13.5% on a leverage basis to market cap, and approximately 8% if you include our current enterprise value. So those free cash flow yields are going to compete with anybody out there. We have very low cash costs, finding costs, and lifting costs. I'll show you that more of that in a second. And we expect our net debt to EBITDA to be around 1 turn by the end of 2021 as we apply the free cash flow to further payment down of the debt. Now, at some point in the future, we expect to be in a position to pay dividends. Right now, what we want to do is get our reserve-based lending facility borrowing base paid down to a very low level, which gives us that much more cushion on liquidity and the ability to pay those dividends. So I would target 2022 as the likeliest time frame at which you could see actually, cash dividends being paid. We trade very cheaply on an enterprise value to EBITDA right now, and if we post something in the 105 to 110 million of EBITDA this year. If you apply just a normal 3.5 turns on that, then the stock price ought to perform very well during 2021. Our year-end reserves, we grew again, even though we really only spent $56.5 million, which was barely over maintenance. You'll see that we grew production slightly, but in essence, the scope was just keeping volumes fairly flat from the fourth quarter of 19 through fourth quarter of 20. And if you apply $2.50 to our gas price or $3 NYMEX, you can see a PV10 of 338 million to 485 million. And just give you an idea, our enterprise value right now is probably 240 million. So trading at a substantial discount to our proved reserves, and frankly, our proved reserves are about 1/3 of our resource potential. So a tremendous amount of upside. Our cap table looks fairly good. We recently announced some additional second lien senior secured notes. The credit facility pro forma to 12/31 is about 81 million drawn on a $120 million borrowing base. We think the borrowing base has a chance of going up in our spring redetermination. We'll know that in about a month. So plenty of liquidity, in particular, that we are established a CapEx budget to grow cash flow and to generate free cash flow. So you can see our production profile over the last several years from 2016 to 2021. It's grown dramatically, and it's really all coming from the core Haynesville. We do hedge as well. We like to protect anywhere from 30 to 70% of our projected volumes through hedging. When the curve is backwardated, it creates a little bit more challenge, but obviously with gas prices moving up recently, we've been able to layer in some hedges through the first quarter of 2022. So again, if you look at my cursor, you can see second quarter of 21 through fourth quarter of 21 is about 100 million a day. It's a combination of swaps. We have 70 million a day hedged on a swap at about $2, a little over $2.50, and then 30% of our hedges float between $2.50 and $3.50. So we love those costless collars. They give you downside protection, but let you run to $3.50. So that we feel like that's a nice hedge to put on. Our guidance, we've just updated this guidance. You'll see that we operate about 80% of our acreage. We're drilling 9.4 net wells this year, a little bit back-end loaded. We originally were more front-end loaded, except for the fact that we had some non-operated well proposals from Chesapeake, who's a partner of ours, on about a little less than 20% of our acreage. Everyone probably knows they've emerged from bankruptcy, and they're going to be drilling 5 gross wells on us. That's a little more than 1 net well, and then the vast majority of our later in the year activity is coming from operated activities. Dan said it, we're really 99% natural gas. If you take the midpoint of both our price realization differential of 20 cents, and then take the midpoint of our cash costs You'll see that our cash costs we expect to average below $1 per MCF. If we get anywhere close to $2.75 to $3 gas, our cash margin is going to continue to expand as high as 2/3, which is really unheard of. I'm going to show you in a second what our cash margin is. Not only is it the highest cash margin of any of the gassy peers, but it's extremely attractive even compared to the oil producers. I'll also show you a return on invested capital. We were 38% trailing 12 months at year end, and that was not only the highest of the gassy guys when you include it with our oily companies peer group, so 34 guys, including all the Permian names. We were the second highest return on invested capital company in that peer group. Let's look at the Haynesville, 26,000 net acres in the play. We are literally in the perfect zip code for the vast majority of our acreage. What we call Bethany to Longstreet sits and it straddles two parishes in North Louisiana. Here is the Louisiana-Texas line. DeSoto Parish is the southern portion of our block. Caddo Parish is the northern portion of our block. We are about 75% undeveloped across this block, and as you look at where our 2021 activity, the majority is going to be just pounding away in our core position here, and the residual will be up in what we call Greenwood Wascom, and I'll show you in a second. Comstock and others have been drilling around us, and frankly, we're surrounded by good production, ring fenced with recent wells, and are able to drill these wells consistently, frack them, and they come on very consistent if you put the exact same completion recipe on them. We're continuing to look for bolt-on acquisitions. As I said earlier, I think you'll see us expand our footprint further. This is what's called, this is the Texas-Louisiana line. If you go southwesterly, this is what's called the Shelby Trough Angelina River Trend. These wells, these rigs here are BP and Exxon. It's deeper as you go southwesterly. This acreage is just as good as from a geologic perspective as North Louisiana, but it's deeper and therefore more expensive. So all of our focus is basically drilling development wells in North Louisiana. If you look at our inventory chart, again, we've broken it out by area. This is that area that I called the Bethany Longstreet area, the bigger block, 16,000 net acres, 26,000 gross acres. You can see of our 559 BCF equivalent of proved reserves at year end, 483 was in the Bethany Longstreet area. And we have 140 gross, 72 remaining locations. But you can see because we are booking reserves at basically 2.5 BCF per 1,000 feet, we still have 751 BCFE of potential reserves left on this acreage block. So this field alone, out of 16,000 net acres, we think has 3P resource potential of 1.2 TCF. It's really phenomenal. And obviously what's changed this whole play in the basin, there are two things. One, longer laterals and better completion technology. There was a time where we were completing our wells with 1,000 to 1,100 pounds of proppant per foot. We're now 3,000 to 4,000 pounds of proppant per foot. We used to frack these intervals. Each stage would be 250 to 300 feet. It's now 100 to 150 feet. And yet, although we're drilling longer, we're completing more stages, our well costs are down about 25% from where they were in the old vintage well. So it's quite remarkable, and that's what's driving our returns, as I'll show you shortly. But you can see, I mean, we have basically 1.85 TCF of resource potential here at the 2.5 BCF per 1,000. And these, we're basically, the proved reserves are done by Netherlands Sewell, so it's third-party engineering. We apply the average BCF per 1,000 to our inventory, and that's where you get to the 1.85 TCF. When you look at well results, it's a busy map, but you look at the well results in our areas, you can see we're just ring fenced with really good wells. And just to give you an idea, if you're not familiar with the Haynesville, when you drill a short lateral, a 4,600 foot lateral, they typically come on at 15 to 20 million cubic feet per day. If you drill a 7,500, they're usually, at least for us in the core, they're usually at least 15 million a day to as much as 25 million a day. And when you drill a 10,000 foot lateral, they're typically 25 to 35 million cubic feet per day. These are remarkable rates. And of course, what you're not primarily focused on is the initial rate. What you want to see is what is the rate over time and how much production do you produce over given times. And there was a day, and Dan remembers it well, I'm sure, where you would drill a well and perhaps get 6.5 BCF from that vertical well. And that was a good well. We'll get 6.5 BCF from our 10,000 foot laterals in year one. And it's really an amazing amount when you think about it. You apply $3 to that, or $2.50 to that revenue, to that production stream, take off your royalty, you can see how at these prices and these service costs, most importantly, we're getting payout at or less than a year on these wells. So really quite remarkable. You look up to our northern acreage, as I mentioned earlier, Comstock been drilling a lot of wells surrounding us. There have even been wells up here north of our acreage block. So really confirm that, again, we should be seeing similar production results to what we see throughout our block. So when you start tracking each of the wells and you see, okay, we initially in red had a 2.5 BCF per 1,000 foot decline curve projected, or a type curve. And then we had a 2 BCF per 1,000 foot curve. You can see we never have come anywhere close to the 2 BCF curve. So we probably should take that off. But these are shorter laterals here, 4,600 foot laterals. The industry average well performance around our acreage, there's 298 wells. You can see the average lateral length is about 4,800 feet. And industry pumped about 2,600 pounds, call it 2,578 pounds per foot on those fracs. And they start off fine, but the older wells were understimulated and they fall off. What we've done, we've come in, and again, completion evolution, where you pump higher proppant concentrations, you tighten your interval spacing, and you get better near wellbore stimulation or stimulated rock volume. And so we're now recovering a much higher percentage of the gas that's in place by pumping almost 4,000 pounds per foot over our 10 well average. And in particular, you see the early time out performance of these wells. When we get to about month 30, the well production is falling on our composite curve, mainly because we have wells falling out that were understimulated, and the ones that are remaining are understimulated relative to our more recent wells. And so over time, you will see this curve. We think as the newer wells come in, the curve will gradually pick the tail end up of this well plotting. Cumulative production, again, here is our 2.5 BCF type curve. For the short laterals, you see 2.5 BCF per 1,000 feet gets you about 11.5 BCF for that well. And we're well above that from our wells. 7,500 foot laterals, again, this is probably optimal. If you're talking about drilling wells on budget or under AFE, and getting results that meet or exceed your expectations. And you can see here our 7,500 foot laterals, which average, again, a little less than 4,000 pounds per foot over 12 wells, are far outperforming our type curve. And then as wells, the newer wells fall off, the older wells were understimulated. So again, we expect as the new wells roll through that composite curve gets picked up. Well above our 2.5 BCF curve, again, as shown in red. We have not drilled many recent 10,000 foot laterals. In total, we have 9 wells that we've drilled, and industry's drilled 187 around us. And I'll tell you, our 9 wells, as well as industry, are understimulated a bit. You can see 3,500 pounds. And that's close to being where it needs to be, but the interval spacing was wider. So I would say the average lateral stage length is about 150 to 175 feet. If you do regression analysis, very high correlation between proppant per foot and EURs, estimated ultimate recoverable of reserves of your well. And there's also a high correlation between interval spacing and EUR. So we think those two are critical. And and there's one additional variable that differentiates our wells, we think, from others, is flowback technique. So what you want to make sure you do is you minimize the pressure drawdown on a given day to probably 10 to 20 pounds per square inch per day. And if you do that, we feel like the well is not being pulled too hard or produced too hard, and therefore you're not going to prematurely produce gas that would have been recovered over time. And we think those 3 things make a huge difference. We have not reported the results yet, but we have just recently completed 2 new 10,000-foot laterals. We are extremely encouraged by early time flowback. So we're hopeful that as we continue to drill 10,000-foot laterals, you'll see this curve again pick up further. And as you would expect, the 10,000-foot results that are tracking our 2.5 BCF curve. Hopefully, again, that starts to beat the 2.5 BCF curve with the new technique. Well, really, production's one thing, but what are your returns? And when you apply our results to the short laterals of 4,600 feet, you can see even at 250 gas here, we're generating about 89% IRR. And of course, this is at the field level. I'm going to show you corporate returns shortly. And then 275 is really off the charts. What is driving the economics in the Haynesville? High volumes, very low lifting costs, high netback price realization off of Henry Hub. We're currently getting 15 cents. It probably averages closer to 20 cents over time. And there's no severance tax in the state of Louisiana until the earlier of payout or 2 years. So you're getting a high percentage of the revenue until you hit your payout. And even then, you can see it's 12 cents per MCF in severance tax once you hit payout. So not a high tax regime. The 7,500s are even better. You're getting more. Your dollars per linear foot drilled is lower because you have a common facility, whether it's a short lateral or a long lateral. But as you're drilling, you're making more progress, more exposure to the rock, and therefore lower dollars per linear foot. You can see even at 250, it's off the charts at 136%. What we would tell you is that this can't last. If you look back, we've been public, been doing this for 26 years. Anytime you have 100% IRRs in the field, either service costs creep back up or prices come back down. I would suggest that the likelihood is service costs creep up, but we think that will take some time, and there's always a lag time on that. We've built in a little bit of service cost escalation into our numbers, and we'll continue to monitor that. Right now, we have excess capacity in the Haynesville. The biggest cost is your frac. It's probably 40% of your completed well cost, including the equipment, as well as sand and fluids. And that so far has excess capacity. So when we were in the peak and service costs were charging us the most, that was about $100,000 per stage to frac a well. It's now about $30,000 per stage. So it's really quite remarkable. And this completed well cost at $8.9 million at one time was $11.5 million. So it's just, that along with increased productivity is what's really driving these rates of return. And then the 10,000-foot laterals, again, we're right on the 2.5 BCF per thousand curve. We think our new wells have a chance of beating those curves. But even if we just hit our curves, we're talking about, close to 100% IRR on the 10,000-foot laterals. Ordinarily, you would say longer is better. And even though this well cost is down $2 million from its peak, the further out you go, the more risk you have on the drilling side. It's not a risk of losing the well or having something catastrophic. It's just whether you can hit your estimate for that well. Many times we hit right on it, but sometimes if you have to replace a drill bit or a bottom hole assembly and you're at 9,000 feet going to 10, that extra trip out of the hole to replace the assembly and get back down could cost you a little bit of money. So that's why we say optimally we're looking at 7,500 foot laterals, and that is the average that we're drilling in 2021. So how do our costs? We've showed you returns in the field, and our finding and development costs, as we announced in our press release, was about 91 cents developed, 31 cents when you include the proved undeveloped that we added. You look at just cash costs, and this would be all of our operating expenses in cash, plus cash interest expense on our debt. You can see we in the fourth quarter were $1.04. And obviously there was only one gassy company that was cheaper than us or lower cost than us at 92 cents. We're projecting this number to be below $1 in 2021. We have no idea about this company. They've not given guidance. And then you can see the others kind of ramp up from there. If you do the flip side of that and you bake in our net realized price in the fourth quarter, which was $2.35, take off the $1.04, that $1.31 off of cash margin, off of the 235 realized price, gets you about a 56% cash margin. So even though our cash costs were second, instead of when you bake in the net price realizations due to being close to the Gulf Coast, you can see our margin is actually the best in that group. And again, if you look at, and that was 235 gas, if you look at 275 or so, and as long as service costs don't rise for lease operating expenses, we think this margin could expand to north of or near 2/3 or 65 to 67%. So we looked at field level returns. What about company corporate level returns? And this is going to probably surprise you quite a bit. So our return on invested capital at year-end 20, if you look at the trailing 12-month EBITDA, was 38%. You can see we beat the next highest gassy guy by 13%. So an exceptional return on invested capital as compared to gassy guys. But what is it as compared to the big universe? You can see we had the second highest return on invested capital among these 34 companies. And you can see we've included Apache, Antero, Bonanza Creek, Centennial, Continental, all the big companies, Pioneer, Murphy, Matador, et cetera. So all the Permian guys, the Marcellus guys, and it just, it's a testament to our acreage position, our completion recipe, our cost structure, both in the field and at the corporate level, that we can be the number 2 return on invested capital of that entire group. And I will tell you, if we hit our modeling for 2021, this number has a chance. It has a chance that we're going to have to change the scale. Let me put it that way, because our projections have us with higher gas prices, obviously, generating higher return on invested capital. So in summary, before going to Q&A and turning it back to Dan, we're projecting both growth, 20 to 25% growth in volumes, cash flow, free cash flow of 15 to 30 million, which is in essence 8% cash flow yield on enterprise value, 13.5% cash flow yield on market cap. We've got plenty of inventory left to go, and we have an expanding cash margin position. So really excited about 2021. Look forward to updating the market throughout the year. And with that, I'll turn it back to Dan.
All right, Robert, good work. I'll tell everybody, you can type your questions into the chat box on my screen. It's right in the middle of the bottom of the screen. Just click on the chat box and type it in there, and I will read the questions to Robert. I've got 6 or 8 here that were emailed to me, so I will go ahead and start with those. Robert, what is Goodrich's realized price, just a guess now, in the first quarter net of the differential and including your cash settlements on hedges? You know what that's going to be roughly?
Yeah, we've not given that specific guidance, but I can tell you, if you just bake in 20-cent basis,
yeah,
and you look at a forecast, let's see, first quarter went off probably. I think, we're projecting that we could average, after basis, call it 255-ish.
Okay, good. Yeah,
So,
in my model, I had guessed 260, so that's pretty
Yep.
close.
Yeah.
And then, do you anticipate laying on any more hedges on back half of the year, or what's the plan?
I think you more than likely could see us layer on 2022 hedges, but as we sit here right now, we're comfortable through the first quarter of 2022.
Yeah.
The problem, as you know, Dan, is the curve is backwardated.
Yeah, that's a problem. Yeah.
And the further we get into this storage shortage season, and the fact that, we think higher gas prices are coming because of that and the demand return, we think the 2022 strip gets lifted. And at that time, as we get a little bit further down the road, you could see us layering in, 2Q 22 through 1Q of 23. But we want to see the movement that we expect to happen. So we've always viewed it as, it's protecting your budget. Our budget is we're very capable of adjusting that on a quarterly basis based on market conditions. We have no long-term rig contracts. We have total flexibility because the vast majority of our acreage is held by production. So we can shift rigs around. And as we said earlier, the vast majority of our inventory is operated. So it gives us a lot of flexibility to move things around. And if obviously gas prices were to collapse, then you could always shift your capital down, and vice versa at some point in the future. Although we're targeting free cash flow this year, at some point in the future, you could see us have higher CapEx. But again, showing discipline, showing free cash flow, we think is vitally important.
Yeah, I don't know what JP Morgan based their projection on, but I think if we have a hot summer, and I think industrial demand, power generation demand is going to come back strong, and I think this is going to be a really interesting year for the gas price, because as you know, you cannot mobilize rigs, and these big wells take a lot of logistics. And it's not like you can run out 50 rigs at one time if you have a shortage. So
that's right. There's usually a 6-month lag on response to market pushing rigs back into the market, making any difference. There's also a 6-month lag on service costs.
Yeah, I mean, it
doesn't happen overnight.
Yeah, not like flipping a switch. Do the wells produce any NGLs?
No, we're
none, just dry gas.
100% dry gas.
Yeah. How about water? Do you have to handle a lot of water or anything?
We really don't have any formation water. You're producing frac water for a period of time, but we think you're only going to produce over the life of the well about 30% of the frac water that you use.
Yeah.
So it drops to a manageable level. And just to give you an idea, when you look at lease operating expense on a new well, initially, because the volumes are high and you don't have that severe, saltwater disposal charge, that we're probably averaging 2.5 to 3 cents per MCF on new well LOE. So it's really just, we've never seen something that low. As the volumes fall, then that LOE gradually shifts up, just by virtue of the fact that you have a fixed LOE component and your volumes are falling over time. But our average LOE this year probably going to be in the 22 cent per MCF range. So these are really low lifting
Yeah.
cost wells.
Well, they're good, clean, high pressure wells
Right.
with not a lot of water to mess with.
That's right.
And when I was with Hess, we drilled a lot of big high pressure wells in Louisiana. Of course, they were deep vertical wells, but man, we had some that came on strong.
Right.
Let's see. Who are the other significant operating companies in the Haynesville?
Yeah, so we are, it's a unique basin in that there are probably 10 to 11 companies that control the core of the play, many of which are extremely large. So Comstock is probably they and Chesapeake are the largest public companies in the basin. Comstock not only was there before, but then they merged with Covey Park, which was a Denham Capital-backed, private company, and they're producing about 1.2 BCF per day net to the company, so really substantial in size. Chesapeake, which just recently emerged from bankruptcy, we think they're probably closer to 650 million cubic feet per day. There's a private company surrounding us to the south called Indigo. Indigo is doing about a BCF per day. Vine, which is a Blackstone backed firm, is actually on a roadshow right now with an IPO planned. What we hear is they're talking about potentially pricing that next week. That's a real positive for us because it gets the Haynesville story widely circulated. People are not going to be able to ignore our well results and how cheaply we trade, because they're going to look at all the peer companies in the play. And so as that roadshow continues, and then hopefully get to a point by the end of next week that they price, we think that's just bringing up a flashlight to the play.
Yeah.
There's a few other ones in there, GeoSouthern it is one, and some smaller guys. Rockcliffe is a quantum energy backed company that's barely into East Texas. They've done a great job. And then you have Osaka with Sabine. They bought in a position there. And you have Tokyo Gas that's bought into what formerly was Castleton Resources. So those are the primary clubs. They have left off a couple, but significant. One other big player who's not active in the play is BP. BP, as you all probably know, bought BHP. BHP had bought Petrohawk, and so this is the old Petrohawk position, and they have really not been active in North Louisiana. They've been active in the Shelby Trough, Angelina River Trend area, but not North Louisiana.
Yeah. Are you guys going to drill wells down that Shelby Trough area this year?
Not this year. It's more difficult because it's deeper. The cost is higher, and the well results are similar.
Yeah.
And ironically, you have the Bossier Shale, which sits above the Haynesville there, just as prospective as the Haynesville. So you have two zones that can work, but it's that added cost that kind of hits your economics. So that acreage is held by production. We're just going to focus this year and probably next year in North Louisiana.
Okay. Let's see. One question was typed in chat, but can you just comment on the NGL market in general? I was looking at propane the other day, and the front month propane contract was up to 93 cents a gallon. So
Yeah.
We're talking like $35 a barrel. I haven't seen anybody report NGL prices close to that in a long time.
Well, a lot of that, believe it or not, some residences are heated in Texas with propane. In fact, I have a lake house that's that very thing. I just got the
we did too. Up in Illinois.
Yeah, awful. Extremely high. So I'd be careful with some of the surge pricing that occurred, because of the storm. In general, NGL prices have gradually come up a bit. That's a great thing for gas, by the way.
Yeah.
Right now, the prices have been so low, they've been pushing it into the gas stream, and if they can process it and sell the liquids, and that arbitrage is better, then you're going to see even less supply in the gas stream. So I think it's likely to keep, rising a bit, just like oil has, just like gas has. But I'm a little more distant from the current market in NGLs just because we don't have any.
Yeah. This is just kind of for some of the people on here, the listeners aren't that familiar with it. You really sell gas by the BTU content. And if the liquids prices are too low, they will leave the ethane and other NGLs in the stream sometime, and that increases the BTU. But as Robert said, so high NGL prices, more people strip those liquids out, and therefore, actually reduce the amount of dry gas available to the market sometime. And that also is going to play into this storage situation as we move forward. I think if the NGL prices continue to be really high, the one thing I saw, when I looked at propane, our exports of propane have just gone way up. I mean, we're a major export. I guess to South America gets a lot of propane from us. Anyway, it's a pretty interesting little market going on there. But if the Henry Hub gas price moves over $3, is there a chance that Goodrich would add a second drilling rig in the back half of this year?
I think we're going to remain more disciplined and then take and bank that additional cash flow, and obviously improve that cash flow yield even further. I think you could see as we get towards the end of the year, going into 2022, we put a 2022 budget together. That's a possibility that you could see us, spend a little bit more next year than we did this year. Right now, our forecasting and planning is just hold the CapEx relatively similar for the next 3 years. But again, we're focused on creating value. And one of the things that the benefit of, as long as you're generating a competitive, superior free cash flow yield, if you can grow, in particular as a small cap company, you're growing your EBITDA, which theoretically, if you just hold your multiple, should create, obviously a good bit higher market cap and stock price, in addition to taking that free cash flow and paying down debt. So you have more value dropping to the equity. So when you look at us, we could have spent $40 million this year in 2021 and held volumes flat. We then modeled 60 million, 80 million, and 100 million. And the difference in 80 million and 40 million is the difference between free cash flow at 80 and free cash flow at 40 was about $10 million. But your EBITDA grows by about $30 million. So again, if you're looking at balancing, how best to place your CapEx budget, we feel like it's a perfect medium to generate, call it 13.5% yield on your market cap, but grow your EBITDA, which is also growing your PDP reserves. And if you just hold your multiple, the stock's going to perform very well.
I am sorry if you can hear my dogs barking in the background, but we've got 2 new rescue dogs, and when Susan goes shopping, they freak out.
Okay.
Anyway, let's see. Oh, of the 9 wells that you're going to complete, and 9 gross wells you're completing in the first quarter, what's the status of those wells? Are they all tied in now?
They are. They're all on, and all but 2 of those are non-operated wells. Some are by Sabine, right there on the Texas-Louisiana border.
Okay.
And 1 is by Chesapeake. And then we have 2 operated 10,000-foot laterals that are on. So I think the reason in our press release we put that our current rate was about 160 million cubic feet per day, that those wells have come on, and that's our current rate. And then our next well to frac is April 1st. It's another 10,000-foot lateral. So you can see we're going to take a step up in volumes in the second quarter, and then continue to step up third quarter, fourth quarter, such that you hit the midpoint of guidance at 165 million a day.
Yeah, I noticed you're not completing as many gross wells, but the net wells are actually higher in the back half of the year.
In the back half, exactly.
Yeah, that's good.
And the only thing that caused us to take our guidance down by 5 million a day was the non-operated wells all of a sudden, being proposed, which caused us to push off and drill one less operated well and then push off our other wells so that we managed our CapEx throughout the year.
Okay.
So first quarter, as we've guided, is going to be much lower than the second quarter through the fourth quarter as far as volumes.
Okay. Let's see. One more question here. Are you interested in selling your Eagle Ford assets?
We would sell that if we got a reasonable price for it. As many of you probably know, not many companies are paying for undeveloped acres, and that is entirely undeveloped.
What county is it in?
It's in Frio County, so it's in the oil window of the Eagle Ford, just barely into Frio County from LaSalle County. So, like for example, Chesapeake again is our offset operator there.
Okay.
So yes, I think if we got a reasonable price, we would sell it. We have no plans to
It's
go.
It's not being marketed, but if anybody,
It's not being
in,
marketed,
yeah.
no.
Yeah,
And
I get
oil
calls
prices
every
are-
once in a while. Yeah, I get calls
Yeah.
every once in a while with people. Do I know anybody that's got something for sale?
Right.
Anyway.
Well, with oil prices where they have been,
Yeah,
no one's paying any price for undeveloped acres. Now in the Haynesville, we have kind of pursued a couple of one-off sales processes where we like the acreage. We came in and tried to buy it on PDP basis. Everybody kept telling us, "Oh yeah, you can get it for PDP." Not in North Louisiana. we didn't get an invitation to the second round.
Yeah.
The offer. So
Yeah.
people are allocating values to that acreage.
Well, it's a good sign when leasehold costs heat up,
Right.
but you never know.
Right.
I actually, this is 15 years ago or something. A couple guys called me and said, "We got some acres over here in the Haynesville, and we're holding it all by real shallow, little production." And somebody from Chesapeake came in here and offered us like $10 million for it. I said, "Well, unless you're going to drill it, go ahead and sell it to them, man, if they're going to pay that." So
Exactly right.
it's more money than you guys can spend in the rest of your life. So what the hell?
That's right. Well, the days of $30,000 per acre in the Haynesville are over, but we see acreage values rising because again, it's all locked down. It's held by 10 or 11 companies. You can't get a foothold without coming to those of us that are.
Yeah, and you got a real good market there. I mean, where you are located close to the Henry Hub and everything, you got good market connections. Where that stuff way out in the Delaware Basin, they got trouble getting it to market. So
Right.
Anyway, so I will end it there, and I'll tell everybody I pretty much updated my forecast valuation model for Goodrich. I will adjust a little bit based on what I heard today, and I will post it to the EPG forum, actually probably in the next 30 or 40 minutes. Anyway, and we are recording this, so we will send out a link to the recording. And I know you guys can share it with your friends. Tell them to join EPG. We need more members. Anyway, thanks a lot, Robert.
Thank you, Dan.
Okay, take it easy. Bye-bye.
All right, bye.